Greetings from 3Edge Asset Management, and welcome to another edition of the 3Edge Weekend Update. My name is Fritz Folts. I'm the Chief Investment Strategist here at 3Edge, and I'm pleased to be joined here today once again by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. As we do each week, Steve and I will provide a brief update on the global capital markets, and then we'll take a closer look at one or more topics that we believe could help our clients better understand the current market environment. So let's get started. Brief recap of the week in the capital markets, and it was quite a week. On Monday, the S&P 500 capped its fastest 50-day rally since the Great Depression. The NASDAQ 100 surpassed 10,000 for the first time ever. But then on Thursday, the ferocious rally in the equity markets seemed to finally hit a wall, as global equities suffered their worst one-day decline since the market correction during March. Investors seemed spooked by a negative economic outlook from the Fed on Wednesday's report out from the FOMC meetings, which seemed to throw cold water on the hoped-for V-shaped recovery. In addition, throughout this past week, there's been a steady stream of worrying reports of spikes in the number of new COVID-19 cases, particularly in states that had eased their lockdowns weeks ago. And lastly, the relief rally from March 23rd had simply broken through a series of technical and momentum factors, which indicated that markets had moved into a more speculative phase, reminiscent of past stock market buying frenzies, many of which ended badly, especially for investors who climbed on board late. As confirmation that equities had reached a euphoric state, earlier in the week, there was an article that quoted an individual investor who said, "I tell people there are two rules to investing. Stocks only go up, and if you have any questions about that, see rule number one." So on that note, let me bring Steve into the conversation here. So Steve, bit of a crazy week in the markets, but what I really think we should do is let's take a look at the Fed and the meeting of the FOMC in the middle of the week. On Wednesday, the Fed provided investors with a very clear forward guidance, suggesting that they intended to leave short-term interest rates basically at zero until the end of 2022. But the markets did not respond positively to that announcement. So what's going on here? I mean, free money for 2.5 years? What's not to like if you're an investor?
So the Fed is trying its best to communicate as clearly as possible what their posture is going forward. Like you said, very clear guidance. And the government, the Treasury, has also been trying to do the same thing. In fact, if we had a scale, Fritz, from 1 to 10, where 1 represented the Fed or the government trying to stand out of the way and let the market be on its own, versus 10, where that would be the most maximum intervention into the markets, the greatest amount of debt being generated to try to rescue the markets, the greatest amount of money being printed to try to support the markets. We are at a 10, and what Chairman Powell reinforced during his talk was to make sure everyone understood we're at a 10. He even went as far as to say that the Fed is not even thinking about raising rates for another 2.5 years. So that's a clear message, and he's trying to say that as a message of support, that they are trying to build a bridge until things get better naturally. Now, the Fed cannot produce a vaccine. The Fed cannot generate business profits, but they can print lots of money and support lots of borrowing from the government, try to get us over to that other side. In the process, the other thing they can do, if they can't build revenues, they can't produce a vaccine, by lowering interest rates as much as they've been, historically lower than ever before, they can make the alternative to stocks, which is primarily bonds, so unattractive that people feel forced to be in the stock market.
Right. Very good. Now, I'm going to shift gears a little bit. And with the dramatic and sudden shifts that we've seen just in the course of this week, I was reminded of a quote from a very famous investor, and it's a quote that you have referred to often. The quote is generally attributed to Warren Buffett, although I think Buffett's mentor, Ben Graham, probably gets some of the credit for the quote. But anyway, it goes as follows. It's in the short run, the stock market is a voting machine, yet in the long run, it's a weighing machine. So once again, in the short run, the stock market is a voting machine, but in the long run, it's a weighing machine. So what do you think Warren Buffett meant by this quote, and why might this quote be so relevant to the current market environment, particularly after such a crazy week?
This is one of my favorite quotes, Fritz, because it really talks about stepping back now and then and seeing the forest from the trees. Everyone gets so involved and so taken by the news item of the day or of the moment, jumping on the trend. Very much a lot of short-termism gets into markets, even from so-called long-term investors' perspectives, that we all need to step back. And one way that Warren Buffett has done well over the years is to not get caught up in the day-to-day. He even talks about not having a machine on his desk, but try to take advantage when things have gone too far in one direction, try to see the forest from the trees and act appropriately. So let's do that now.
Okay.
One way to see the forest from the trees is, again, to remove ourselves from the day-to-day, but look big picture to see, is the market, after all the ups and downs and machinations, is the market in overvalued territory? Is it fairly valued? Is it undervalued? When you look long-term, at least 10 years or more. And one way we can do that is to look at a chart that we'd like to share with you. This is one of our favorite charts, and it shows a very, very strong relationship that I will explain. If you compare how much all the businesses in the country, let's say all the US companies in the stock market of the US, if you look at how much business they generate in terms of dollars of revenue, and then you look at how much does it cost to buy a share in those collective companies, say by buying the S&P 500 index, and compare the cost of buying a share in those companies with the amount of revenues they generate. That tells you so much about the likely returns you're going to get in the next 10 years. And all of the data backs that up. And it's not just the US, it's the other countries as well. So if we look at the US, we show a chart. And the left scale shows the price to sales ratio, which is simply that ratio of how much does it cost to buy a price per share, what's the price per share of the stock market, compared with what are the sales per share that that market is generating. And when there's about a one-to-one relationship, we've known in history that the amount of money you can expect from your investment in the stock market over the next 10 years is going to generate a very attractive return. Now, if the ratio is 2-to-1, we know from history that the market might go up in the short term, sure, might go down, but over the next 10 years, you're likely to make a poor return, maybe just above zero, maybe not even. So that's what history shows, and it's shown that for over many years, over many cycles across different countries. So if we look at that chart, we see a very strong relationship between the price to sales ratio, which is that line that extends from left all the way to the right, and the compound annual return of the stock market, what it really achieved over the next 10 years. The relationship is strikingly strong. And what that graph tells you is that right now, after this big rally, we're back into overvalued territory. And while the chart doesn't tell you at all what the stock market might do in the next week or month or next few quarters, it does say that we are in overvalued territory, and a simple buy and hold strategy is not going to be generating as much return as you would hope, because that ratio is now back to 2-to-1. However, if we look at other countries, and we'll start with Germany, number one, we see that same very strong relationship between the price to sales ratio and what did investors in the German stock market earn over the next 10 years at any given level of price to sales. Again, that same strong relationship. And what it's telling you now is today, German stock market is much more fairly valued than the US market. Now let's do the same thing for Japan. Here, we see the Japanese stock market also as being very fairly valued, you might say undervalued. The price to sales ratio is actually less than 1. And although the Japanese stock market for each unit of sales doesn't typically have as high a profit margin as the US, in a relative basis, Japan is clearly undervalued, and buying the Japanese stock market now at this low price, given the amount of sales that Japanese companies generate, should lead to a very decent return over the next 10 years. And then finally, emerging markets. And here we look at taking collectively the emerging markets of China, India, and Brazil. Those are the three largest. We make a composite. And then we add some other emerging markets to create the MSCI Emerging Market Index. And we compare those ratios as well. And like our other international equities, emerging markets also is fairly valued. So in the short term, the markets will go up and down together. There won't seem to be a lot of difference. But longer term, we want to put some money to equities. We don't want to put it all in US because US is arguably overvalued. We want to spread that money around the rest of the world.
Very good. Very, very helpful, particularly in a week like we've had this week with just so much volatility. I just want to make one more quick comment, if I could, about the Fed announcement and the future of interest rates. As you said, Fed Chair Powell's message was one of concern over the trajectory of the economy. And the Fed's message included this very clear forward guidance to the markets, indicating low short-term interest rates for the next 2.5 years. And for me, this rather extreme forward guidance from the Fed, indicating their intention to keep short-term rates down for so long, in some respects brings into question the efficacy of a traditional 60-40 portfolio of stocks and bonds, right? Particularly on the bond side of the equation, because you're no longer going to get the double benefit of holding those bonds to, as a hedge against your equities, where you would get yield and capital appreciation, because now aren't you basically at risk of having both of those go against you? So I really do think this is an indicator that you really, in this environment, you've got to think beyond just stocks and bonds, and you've got to think across multiple asset classes and different types of portfolio construction. Maybe a topic of discussion for another day. But Steve, thank you very much for all of your insight. Very, very helpful. That will do it for us. Steve and I will be back next week with another edition of the 3Edge Weekend Update. And remember, all of our videos are available on our YouTube channel. Feel free to share these videos with anyone who you think might be interested. On behalf of Steve and everyone at 3Edge, we urge everyone to do everything to remain safe, stay strong, and keep the faith. Thanks for listening. And Steve, thank you very much again.
Thank you, Fritz.